Hi and welcome to the Financial Sigma. Investing 101, the basics of investing and how to get started. Investing is the process of using your money to buy financial instruments or other assets in the hope of generating a return on your investment. Some common investments include stocks, bonds, mutual funds, and real estate. There are many reasons to invest, including the potential to grow your wealth, generate passive income, and save for long-term financial goals such as retirement. However, it's important to remember that investing carries risks, and it's important to carefully consider your financial situation and risk tolerance before making any investment decisions. So, if you're interested in getting started with investing, here are some basic steps to follow. Determine your financial goals. What do you want to achieve through investing? Do you want to save for retirement, generate income, or grow your wealth? Your investment strategy should be tailored to your financial goals. It's important to start by identifying what you want to achieve through investing. Do you want to save for retirement, generate income, or grow your wealth? If you are saving for retirement, you may want to consider investments that offer the potential for long-term growth, such as stocks or mutual funds. These types of investments can help to grow your wealth over time, but they also carry more risk than more conservative investments like bonds. If you are looking to generate income, you may want to consider investments that pay regular dividends or interest, such as rental property or bonds. These types of investments can provide a regular stream of income, but they may not offer as much potential for long-term growth. If you are simply looking to grow your wealth, you may want to consider a mix of investments that offer both growth potential and the opportunity to generate income. A diversified portfolio that includes stocks, bonds, and other assets can help to balance risk and reward. It's important to keep in mind that your investment strategy should be tailored to your financial goals and risk tolerance. It's a good idea to consult with a financial advisor to help determine the best investment strategy for your specific needs. Assess your risk tolerance. Different investments carry different levels of risk, so it's important to consider your risk tolerance, that is, your willingness to accept the possibility of losing money, before making any investment decisions. Assessing your risk tolerance is an important step in the investment process. It refers to your willingness to accept the possibility of losing money in exchange for the potential to earn a higher return on your investment. There are several factors that can influence your risk tolerance, including your age, financial situation, and investment goals. For example, if you are younger and have a longer time horizon, you may be more willing to accept higher levels of risk in exchange for the potential for higher returns. On the other hand, if you are closer to retirement and have less time to recover from potential losses, you may be more risk-averse and prefer investments with lower levels of risk. There are several ways to assess your risk tolerance, including online risk tolerance quizzes and discussions with a financial advisor. It's important to be honest with yourself about your risk tolerance, as taking on too much risk can lead to financial stress and potentially jeopardize your long-term financial goals. On the other hand, taking on too little risk can also be a problem, as it may not provide the potential for the returns you need to meet your financial goals. Once you have a good understanding of your risk tolerance, you can use this information to help guide your investment decisions and choose investments that are appropriate for your risk profile. Create a budget. Before you start investing, it's important to have a good understanding of your financial situation. This includes creating a budget to track your income and expenses and getting your debts under control. Creating a budget is an important step in the investment process, as it helps you to understand your financial situation and identify areas where you can save money. To create a budget, start by tracking your income and expenses. This includes all sources of income, such as your salary, any investments or rental income, and any other sources of money you receive. You should also track your expenses, including bills, groceries, and any other regular or one-time expenses. Once you have a good understanding of your income and expenses, you can start to identify areas where you can cut back and save money. For example, you might be able to save money by cutting back on unnecessary expenses, such as dining out or subscriptions, or by negotiating lower rates on bills like your cell phone or insurance. It's also important to get your debts under control before you start investing. High levels of debt can be a financial burden and can limit your ability to save and invest. If you have high interest debt, such as credit card debt, it can be a good idea to focus on paying this off before you start investing. By creating a budget and getting your debts under control, you can free up more money to save and invest, which can help you to reach your financial goals more quickly. Start saving and investing. Once you have a handle on your finances, you can start setting aside money to invest. This can be done through a variety of vehicles, such as a 401k plan at work, an individual retirement account, IRA, or a taxable brokerage account. Once you have a handle on your finances and have identified your investment goals and risk tolerance, it's time to start saving and investing. There are many different ways to save and invest, and the best option for you will depend on your financial situation and goals. One option is to contribute to a 401k plan through your employer. A 401k is a type of retirement savings plan that is sponsored by an employer. Contributions to a 401k are made on a pre-tax basis, which means you can contribute a portion of your salary before taxes are taken out. This can be a tax-efficient way to save for retirement, and many employers offer matching contributions, which can be a great way to boost your savings. Another option is to open an individual retirement account, IRA. An IRA is a personal savings plan that is designed specifically for retirement. There are two main types of IRAs, traditional IRAs and Roth IRAs. Traditional IRAs offer tax-deferred growth, which means you don't pay taxes on the investment earnings until you withdraw the money in retirement. Roth IRAs, on the other hand, are funded with after-tax dollars and offer tax-free growth and withdrawals in retirement. A taxable brokerage account is another option for investing. This is a personal investment account that allows you to buy and sell a wide variety of investments, including stocks, bonds, mutual funds, and exchange-traded funds, ETFs. With a taxable brokerage account, you can choose your own investments and have more control over your portfolio. However, it's important to note that investment earnings in a taxable brokerage account are subject to capital gains tax. It's a good idea to consider consulting with a financial advisor to help determine the best savings and investment options for your specific needs. They can help you to choose investments that align with your financial goals and risk tolerance. Diversify your portfolio. It's generally a good idea to diversify your investments by owning a mix of asset classes, such as stocks, bonds, and cash. This can help to spread risk and potentially increase your chances of earning a positive return. Diversification is a key principle of investing and refers to the practice of spreading your investments across a variety of asset classes in order to manage risk. It's generally a good idea to diversify your portfolio by owning a mix of asset classes, such as stocks, bonds, and cash. Diversifying your portfolio can help to spread risk and potentially increase your chances of earning a positive return. For example, if you only invest in stocks and the stock market takes a downturn, your entire portfolio may suffer. However, if you also have investments in bonds, which tend to be less risky than stocks, your portfolio may be less affected by market fluctuations. There are many ways to diversify your portfolio, including investing in a mix of different types of stocks, such as large cap, mid cap, and small cap stocks, and investing in a variety of sectors, such as technology, healthcare, and finance. You can also diversify by investing in different types of bonds, such as government bonds, corporate bonds, and municipal bonds. In addition to diversifying within asset classes, it's also a good idea to diversify across asset classes by investing in a mix of stocks, bonds, and cash. This can help to further spread risk and potentially increase your chances of earning a positive return. It's important to keep in mind that no investment is risk-free, and it's not possible to eliminate risk entirely. However, diversification can help to manage risk and potentially increase your chances of earning a positive return over the long term. Remember, investing carries risks, and it's important to do your own research and consult with a financial advisor before making any investment decisions. Thanks for watching this video on Investing 101. We hope it's been helpful and that you feel more confident about getting started with investing.